yourself, Gideon, too. You were rushing to get to this. So, and I was stuck in traffic and it was not fun. I mean, it just kept adding minutes and moments to my travel. And then I don't know, there was something in the street that had held up the traffic a little. So yeah, so let's give people a bit of time. In terms of the upcoming events, I'm looking forward to May. We do have quite a bit coming on in May, and that's what we were just chatting about with Austin. If you are looking for live events to attend and events that provide you with more ways to be involved in real estate, the multifamily event is something that takes place this coming month. So we're also at another event this weekend, In the Black, it's called, and it's sponsored by TD Canada Trust and Black Moms. So I'm excited about that. Today is Thursday. Yes, so it's Saturday, Sunday of this weekend. So a busy month for April, but even more busy the month of May with extra events available around the city. So let's get started. Right, is it 7 yet? No, we still have a moment. I'll give one more. We still have another minute. So
people are still joining, Andrew, so maybe 2 minutes after.
Yeah, we can wait till a couple minutes after as well.
Okay.
Yeah. Yeah, I think it's a bit of a rush. I do agree that 7's a great time to start, but depending on whether you're traveling, like more of us are out to work now rather than working from home all the time. Sometimes we're having to go into the office. Today was the first time in a long time that we had to come into the city for something that, we've just been doing on Zoom for the longest time. And I was like, oh, today of all days. And the city meant into Toronto, right downtown. It was a little bit busy. It's definitely evidence of back to normal, nothing like it was during the pandemic when I was in the city, especially living in the city. It was almost a ghost town. The streets and the roads were so empty. That's not the case anymore. Yeah, so. So another minute or so. Thank you for those of you that have joined on time and are here to learn and find out more. And especially if you've been here and it's your second time, maybe you were here at the first session that we hosted in the fall. We did do another Earn While You Sleep earlier this year as well. And we focused more on other ways to invest passively. And so today we're back to investing passively using real estate investment trusts. So passive investments is great. It doesn't pull you in 5 or 10 or 20 different directions like an active investment does. Okay, so maybe another minute, or shall I start? I'll start. I think that it's okay if people are joining still, but thank you everyone for joining us. Myself and Kemba are always interested in making sure that we bring knowledge to you on ways that you can be invested and or earning in real estate. And so tonight we're going to focus largely on how you can earn while you sleep and how to unleash your income potential. So let's begin. Kemba's not here tonight joining me. She had another event to attend and represent ourselves as a company, but she is my business partner and my sister-in-law, and that's why we share the same surname. We are very, excited that as a duo, we are very passionate about ensuring that both our family and the families of others are able to build wealth through real estate, similar to what we've been doing. We first started off doing it on our own, and then we decided, as we saw people very interested in what we were doing, building it through our company, Keen Real Estate Group. And so we've definitely been always education focused, where we are making sure that we bring you the knowledge either through our own personal experiences or through other partnerships and companies that we work with, such as Equiton, which we'll introduce you to shortly. We both have a financial services background. Kemba was in banking. I come from working in the sector where I was providing investments, insurance, and so we definitely have a strong financial background. I'm also a former school teacher, so I understand the benefit and knowledge, or the importance of knowledge and education. And so together we have 35 years of experience, and we bring that to you. And as I said, that is experience not just includes our financial services background, but our own personal experience investing in real estate and investing passively in real estate, like we're focused on tonight. We've accumulated a real estate portfolio of $15 million plus. We are local, so here in the Toronto and GTA area, Ontario. We're also across Canada. We're national, international. So we've, spanned and moved ourselves into the US, the Caribbean, and Central America. So we definitely see the benefit of ownership and property ownership, as well as investing passively. And you can do that passively locally here as well as abroad. Our focus has typically been buy and holds, and we've been buying and holding real estate for some time. First individually, and then collaboratively once we realized that we shared a similar interest and passion. And so we own from condos to apartment buildings, and land development is something that we've been focusing more heavily on recently. One of the areas that we know is so important to build our education and knowledge is reading. Reading has definitely been and it's cost effective and an easy way to gain knowledge, because oftentimes books are very inexpensive. You can even get them free at the library, or you can today, I love it, you can pick it up on Audible, like get an audio version, so that you can essentially read a book a day or a book a week, depending on your interest and your what you do. I find that the books are great for building knowledge. This one is one of the ones that I definitely think is a great read. You may have heard of Robert Kiyosaki in terms of his Rich Dad, Poor Dad. Well, the cash flow quadrant is his follow-up to the Rich Dad, Poor Dad. So definitely, if you've read the first version of his book, Rich Dad, Poor Dad, you want to read the cash flow quadrant, because really what it tells you is that you can make income in any of these four quadrants, like any area. You could be an employee, a self-employed individual, business owner, and investor. But the workload and the effort that you put in will determine and dictate how much and how quickly you can build wealth. On the left side of the quadrant, where you have the employee, self-employed individuals, it tends to be that you, as an individual that is working for someone or working for yourself, the likelihood of building wealth is a lot more. It's more harder. There's more work to be done, because you are typically trading your time for money. And so it may take a little bit more time. And if you want to build faster, then you want to work to get into the right side of the quadrant, where you have the business owner investor. And tonight we're going to focus obviously on the investor, because we realize the likelihood of building wealth and amassing greater wealth for you is available when you become a business owner, or when you learn to become an investor. And so as an investor, you're now learning to take your money and put it to work for you. And that's how we get the earn while you sleep, because you only have so many hours in a day that you can work and so many part-time jobs that you can take on. And then you're spent and you don't have any more time to allocate to a job. And so taking your money and putting it to work, especially if you've accumulated money already at your job, because typically that's some of the source of the money that you would find to invest, is that you might have a pension plan, an RSP, or a stock or stock sharing plan at work that you can then take that money and learn to put it to work for you. So definitely what we find and what Robert Kiyosaki shows in this book is that a greater portion of wealth tends to be on the business investor side of the quadrant, or the cash flow quadrant. And so I myself am working towards being on the right side of the quadrant, where I know I can build and amass greater wealth in a shorter period of time, and using the efforts of my money working for me too. One of the concepts that I've learned, and I didn't learn this in school, and I know, as I said, I come from a school teaching background, but I found that there was a lot of things that I didn't learn in school and I had to learn later in life, either through reading books or talking to individuals who have been successful investors or successful business owners on what types of things, they felt it would be beneficial to know. And one of these rules is the rule of 72. And what the rule of 72 is, it tells you how quickly your money can double. And 72 is a constant, very similar to, I know we learned a lot of formulas in schools, like, pi and so on. Well, it's a constant. It's a formula that you use, and it's very simplified than what I'm doing here. There's a much more complex formula for the rule of 72. But if you just take the constant 72 and whatever it is that you're earning divided into 72, it will tell you approximately how long before your money doubles. And in the event that you're trying to figure out, am I keeping myself in debt for too long? You can use the rule of 72 to figure out how long it'll take you to come out of debt as well. So the rule of 72 says, if you can earn a double-digit return like 12%, and you're like, yes, Andrea, but where do I earn 12%? Well, we're going to show you places that you can invest and earn 12%. So you take the 12, divide it into 72, and it tells you that every 6 years, your money can double. And to me, that's fantastic. If I can get my money working and spending, turning over it quickly, I'm going to be able to amass, as I said, greater wealth. And that's what we're teaching you, how to be and build greater wealth. If you look at what you're investing in at the bank, and I don't know if you know the returns you're getting on the bank, but I know that when I was investing, I learned very quickly as a young person that leaving my money at the bank didn't allow me to amass much wealth. And even my 19-year-old daughter said to me recently, she got a T slip from the bank. And she's like, I can't believe that they, sent paper out to tell me, the cents and dollars that I've earned, because it was so minuscule what she earned. Because typically you're earning 0.00, something, 1% or something. So it's very negligible. And if you divide that into 72, it's going to tell you that maybe it's a negative, you're going to be into the hundreds of years before you can actually amass anything of significance. So the rule of 72, really good concept for you to keep in your ammunition of like how to understand how money works and how you can get your money working harder for you and not working so hard. Because I know most of us work very hard. We put in a lot of hours, and oftentimes, especially as we looked over the last few years, we probably haven't seen significant increase in our earning potential, our income at work. We also haven't seen a lot of great returns as well, because the market has been pretty volatile. Well, the investments that we're going to show you today have been able to do really well, because one of the things that I've learned very early in my real estate career is that no matter what, I understand that real estate, similar to any other investment vehicle, does go up and down. But what I've seen is the trend is consistently up. And as long as you are staying the course, when, like, for example, like last year and the start of this year, where the markets were down, if you're staying the course and you're not selling during a down market, then you are definitely going to profit. So this is my investment story. When I started investing in passively in real estate, I realized that it wasn't easy to always come up with a large lump sum. And a lot of these investments did ask that you had a minimum of 25 or 50 or 100,000. So in order to start, I partnered with another sister-in-law, another family member to put in 100,000 together in an investment. And that was actually a mortgage investment. So we were lending our money to an individual to finance their real estate, and so we were their lender, so to speak. And we put that 100,000 to work because we learned that we can earn 15% return on that mortgage investment. And that meant for us, especially myself, who was self-employed and in a field, right, real estate investing, my income is not steady and consistent, it's up and down. And so this allowed me to have that, consistency of income coming in annually. And yes, I shared it with the person who I was invested with. But because she herself didn't need the money annually, she opted to take it at the end. And so I could use it as income for myself at the outset. And so 15,000 annually as an extra, earn while I sleep was fantastic, because that income was coming in steadily and I could rely on it and I could depend on it. It also, again, if you go back to the rule of 72 and you take the return of 15% divided into 72, it now means that instead of doubling every 6 years, like 12%, you're now doubling every 4.8 years, which is amazing. And so if I left that 100,000 for the entire term of the 4.8 years, after that, less than 5 years, I now have 200,000. And that to me is phenomenal return on my money. So without, having to manage tenants, without having to deal with any property management issues or fixing any properties, I could now have, 200,000 come back to me at the end of that term. So in these investments, oftentimes you could, depending on how it's established, you could take the capital up front, or you could choose, like the earnings, you could take your earnings up front, or you could choose to take it at the end. I did a combination in some, because depending on what my needs were. And so you too can do the same. You could decide what makes and meets your needs to make sure that you are, you're thinking of the tax implications, and because if you're employed, the tax implications of receiving an extra 15,000 may not be beneficial, right? So you could defer and have it come to you at the end, or split it over a period of time. So outside of investing in that mortgage investment, I had learned to do some land development, and myself and Kemba has also started building land development in our portfolio as well. And one such land development project is a property that we bought in Brampton, that we refer to as Rogers Road, because that's the street it's on. The company that we bought it through is our company called Can Dream Developments. And so our goal is to take that property. It's a large lot with a single residential home on it. We're going to, break it down, like sever the lot, take the 2 lots and build a triplex on it, on each lot, so that we'll end up with 6 units. But right now what we're looking for is a minimum of 50,000 to invest in this project to help to finance the project, because a lot of the times, and if you're not familiar with land development, a lot of land development is not based on getting financing from the lender or a bank. Typically, it's you yourself and or private investors that help fund the deals. So we're looking for investors who have a minimum of 50,000. We'd offer them that 15% return, and we're looking for a term of 18 to 24 months. Just like the one example I showed you before, and the ones that we're going to speak to shortly with Austin at Equiton, is that it's an earn while you sleep opportunity. This is just through land development. And if you want to know more about anything that I say tonight or that Austin says tonight, you can book a meeting with myself, and we're happy to help you understand more about how you yourself can get involved in what we're speaking to tonight. And by the way, Welcome, everyone. If you can take a chance before I introduce Austin, if you could just take a time and just share in the chat maybe where you're coming to us from. Are you local in the GTA, Hamilton, wherever you are? If you can just type in the chat where you're from and maybe what it is that you would like to gain from tonight's session. I would just love to look and see who we have on the call tonight. Some upcoming events that we have and that we have coming up in May and our event in September. In May, we have two that we think would be great for you to consider. We're going to have a property tour of that same land development project, the Rogers Road that I just spoke of. That's May 18th. In the evening, 6:30 to 7:30. So if you're interested in learning more and seeing what the property and the project looks like, we'll be sharing more about it that evening. On May 25th, we're going to show you how to analyze and look at a pre-construction purchase and how that could be a beneficial deal for you if you're looking to buy and purchase a property. So I know we're focusing largely on passive investments tonight, but there are many of you that may have already bought or are looking to buy. And so we're going to talk about the anatomy of a deal on May 25th. If you want to pay attention, we'll be sharing those details and how you can get registered for that. And then just for a future date, our September 30th, Earn While You Sleep live event. I know we've been doing a lot of it virtually, but we want to have a live in person where we're going to have some of our partner companies that will be there sharing with you opportunities. And that will be September 30th, likely held in the Brampton area. And so put, in your calendar for now, and we'll come back to them. Now I'd like to get to our guest speaker. Yes, hello. I'd like to get to our guest speaker, Austin Rogers, who will be speaking to you about who he is and what his company offers to you in that Earn While You Sleep opportunity to build and get your money working for you to build a portfolio. Austin, I'm going to turn it over to you, and I'm going to stop sharing so that you can start sharing.
Perfect. Thanks so much, Andrea. Appreciate you making the introduction. Let me share my screen. Let me know when you can see it all okay here. So can you see that okay?
Yes, I can.
Wonderful. Before I go into anything, I always think it's good to give you a bit of background as to where I'm coming from and my experience in real estate to give you an idea how I even ended up here, because traditionally speaking, this is a market that's probably going to be new to a lot of people, but that's also why it's exciting. So I originally started working with one of the top 5 banks in Canada, going through the financial advisory route. So think about it, anytime you would have gone into a bank and asked to make some investments, I would have been one of those people you would have spoke with. And really, one of the things I found after about 5 years of being with the bank was that it was a very cookie cutter approach where everybody was asked the same questions. And based on where you answered those questions, you kind of just got landed in a bucket. And that was something I never really enjoyed, because once you invested into it, I didn't really know what was going to happen with the portfolio. It was really up to what that bank did with the investments. And there was a lot of volatility in the market. But here's the thing. I came from a background of real estate. My father was a mortgage broker, and my mother was a real estate agent. So I was very fortunate to grow up in a household where I was able to learn a lot about buying real estate and financing real estate. But inevitably, I still liked the investment route. So when I started to look for something outside of the bank, I ended up finding out that there was an opportunity to get involved with real estate investing, but passively through an investment vehicle. And that's really where Equiton comes from in terms of how it may fit into your portfolio. And that's why I'm excited to share with you, because it's something I'm very passionate about. It's something I'm very familiar with. And I think that this will be a great learning experience for everyone, regardless of if this ends up fitting for something you find interesting. So let's jump into the presentation, because one of my opening questions is going to be to the audience to find out kind of where you think real estate is at currently. So one of the first slides that I'll actually show you here is going to be, what are the 5 most expensive cities in North America? And when I ask this question, I'd be curious to see some people put some answers in the chat. And I don't mean expensive in the way that, yes, Los Angeles has expensive home prices, I mean expensive in terms of the average income in that area versus the average house price in the area. And we are talking North America. So I'd be very curious to see what a few people in the audience might think is the most expensive cities in North America. So I'll give you just 2 seconds to throw some answers in there, and then I'll show you. So Toronto and New York, yeah, very standard answers. I love that one. I think we all know it's probably going to be in the top 5. So you're definitely right about that one. New York, I think, is another great one. It's definitely one that stands out to most people. Brampton, Los Angeles, BC, definitely some good answers coming in already. So here, let me show you a couple of these answers because I think this is what's going to surprise you. Make important note of which country, whether it's the United States or Canada. So the very first one is going to be one that I don't think is going to surprise any people at all. We are going to be talking about Toronto. So that is the 5th most expensive city in North America, but this is where it gets surprising. Hamilton. Hamilton is the 4th most expensive city in North America. And again, that's from an average income versus average housing price in the area. Vancouver, I don't think that's a big shock to many of us. Mississauga. And as you can see, 4 of the top 5 most expensive cities in North America are here in Canada. And as one of the users here pointed out, New York is definitely coming in at first for the most expensive city. What I wanted to always kind of highlight here is that Canada has become one of the most expensive places to live from an affordability perspective. And that plays a big role into why Canada becomes such a great vehicle for real estate investing. So a couple of headlines I like to really point out here is, have a look at any of the ones on your screen here. People are unable to buy and more people are turning to renting. Average rents in Canada soar above $2,000 for the first time ever. And tips for first-time homebuyers as affordability in Canada continues to deteriorate. I'm almost certain all of us have probably seen headlines along, the route of this over the past couple of years, but more importantly, over the last, I would say, 14 months, as we've seen interest rates start to skyrocket. And that's a big part of understanding where is the best place to invest in real estate now that we're in this specific dynamic. And what I like to show people is a chart actually of our Canadian pension plans. Now, the reason I'm going to show you this chart about the Canadian pension plans is because these pension plans pay billions of dollars to know where to invest their money because they have a fiduciary responsibility to ensure that there is some form of income when we all get to retirement. So the key point there is that, yes, they have to make a return on their investments, but they need to do it in the way that is the most risk adjusted, meaning a good return without having to risk too much of the money. So if you take a look at the chart here from 2005 to 2020, what you'll notice is that these big pension plans have gone from having an allocation in alternative investments from 14% back in 2005 to 42% today. And this is a big part of the conversation because with Equiton, we deal with alternative investments. And it just so happens that our alternative investment falls into the real estate space, which is a big focus for these pension plans. So to give you an idea of who Equiton is, because now you know that we're in this alternative space, I'd like to illustrate to you just how big we've gotten in the last few years. This company was launched in 2015 with 3 employees. And the CEO of our company actually funded the first purchase of real estate through this company of $20 million himself. He still maintains that investment to this day, and he's actually our largest single shareholder in the company. But fast forward to today, you're looking at 7 years later, we now have over 9,000 individual investors and over 150 employees. I actually joined back in early 2019, and that word AUM there, it stands for Assets Under Management. Think about it as how much real estate we own within the company. So when I joined in early 2019, we were at about $100 million of real estate assets. What makes me so passionate about the company is the fact that I've been able to be here for 4 years. I've seen the COVID crisis of 2020. I've seen the interest rate headache of 2022. And yet I've watched the company increased by ninefold from $100 million to $918 million today. And I'm happy to say I've been a big part of that as well. So this is what's exciting about Equiton, is that this is a Canadian company. It's Canadian owned, Canadian operated, and we're focusing on the alternative real estate space here in Canada. That's so important. The only reason I kind of put this chart in is because I think it really shows the growth that we had ever since COVID. You know, it was one of those things that I think in the investment space that made everybody get a little bit worried and scared about what was going to happen. But for our business, it was phenomenal because it started to make people realize that there's a ton of volatility out in the marketplace. And where can you go to find some safe investments? Everybody loves real estate. Everybody loves the tangibility of real estate. And that's what we offered here. And that's the reason for some of this growth, and why I think it would be very interesting for all of you to learn a little bit more about it and see if this is something that also interests you. So a big part about alternative markets is understanding that you're not buying our investment on the stock market. You're buying our investment through the private markets. To keep this simple, I don't want to jump right into private markets. I want to tell you about what's more traditional to most of us. You know, on the top, you're really looking at the stock exchange. And the reason I've kind of put this on the screen is to show that, you know, over a long period of time, you can do well. But how much money you make with the stock market isn't so much about when you get on. It has a lot more to do with when you have to get off. And I truly mean have to get off. Because if you were planning on retiring in March of 2020, that was your retirement date. Well, guess what? A bunch of your pension and your retirement fund took a huge hit. It made you worried about where that income is going to come from. And, you know, even more recently in 2022, there was very tough performance in the stock market. So if that was your year to retire, you may have thought, maybe I need to work for a couple more years. So there's a lot of volatility, and I like to refer to it as a bit of a roller coaster. So if you don't want to go with the stock market, you can go with something on the bottom of your chart, like a GIC. I mean, the unfortunate part about GICs is that because inflation's so high right now, you know, still upwards of 5%, you know, the best sort of GIC you can get right now might be 4 to 5%. You know, you're not doing anything than other kind of guaranteeing that you're going to lose buying power over the next 12 months. So the big thing here is that, like I said, when you walk into the bank and you say you want to make some investments, they're just going to give you some mix of fixed income, which can be like bonds, you know, GICs, and equities, which is essentially just stocks. But the question I always have for a lot of people when they bring up this mentality is that I say, you know, are you truly diversified? And the truth is that you're probably not diversified, because think about it. If these pension plans who are making great returns and are risk adjusted are putting all their money into alternatives, 42%, I mean, shouldn't we be doing the same thing? That was always a bit of an eye opener to me. And so when you look at these private markets, the big takeaway I want you to have with it is that it's very similar to the public markets, except that it doesn't trade on a stock exchange every single day. And if there was one key takeaway I could give you with the private markets, it's that the value of our investment is tied directly to the appraisal value of our underlying properties. So you get a much more realistic valuation of what your investment is worth based on these physical real estate assets here in Canada. And actually, a slide I'll get to a little bit later on is that actually prior to 2016, this investment was only available to a few high net worth individuals, but that's now changed. It's opened up to almost everybody here in Canada. I don't think I need to spend too much time on, you know, why real estate makes sense as an investment, but here's just some of the key takeaways from private real estate. You know, less volatility, low correlation of stocks, consistency of returns, and it's a good hedge against inflation, which we're dealing with a lot of that right now. But don't take my word for it. What I'd like to show people is that there's actually an index in Canada called the Private Canadian Apartment Index. This data actually comes from a company called MSCI. This is a phenomenal piece of info. Over the last 38 years, this Private Canadian Apartment Index is the only index in Canada to never have a negative year in 38 years. And that includes all the major events that you're seeing here right in front of you, including the recent inflation crisis, all the way back to Black Monday in '87, and the tech bubble as well too. So this slide is a little bit busy, but just look at the orange bar on the left side. That right there is the Private Canadian Apartment Index, and the blue number in the middle is the average return over 35 years, 10.14%. But more importantly, look at the lowest return in 35 years. It was still positive at 1.7%. So if you go just 2 bars to the left, Canadian equities or Canadian stocks, you'll actually notice that the average is less over 35 years, 9.3%. And then if you look at the volatility, the high of 35 and the low of 33, well, again, what if that was your retirement year? The point I try to make here is that real estate is a great investment class, but specifically when you're doing it passively and earning while you sleep, you can get these really solid returns while not having to do any of the legwork and feeling comfortable about the asset class you're buying into. So let's talk about who can invest, because I think this is important to most of us here. I'm not going to spend too much time on this slide, because if you want it, take a snapshot now. You can get the presentation afterwards. You can see the recorded version. Essentially, someone who's accredited, very high thresholds, but you don't have an investment limit. These were the only individuals who can invest prior to 2016. They introduced this new category called eligible investors. There's a bit of variance province to province, but generally speaking here in Ontario, this is how it looks. If you've got a personal income greater than 75,000, or a household income greater than 125,000, or a net worth greater than 400,000, you can actually now make an investment up to a maximum of $100,000 every 12 months. And here's the good news. Even if you don't make that income or you don't have that net worth, you can still start with a maximum investment of $10,000. And what you'll find in a couple of slides from here is that our investments actually start with minimums as low as $5,000 and $10,000. So why invest in real estate? I won't spend too much time here. I think it's pretty obvious that these are hard assets. They give you some capital preservation. In inflationary markets, they do very well. It's a steady stream of income. And even if you're buying it actively, you can use some leverage on it. Here in Canada, I think it's one of the most obvious places what's driving the demand. Demographics and population growth have just exploded over the recent few years. There's a lot of land scarcity, which I'll actually touch on in a slide from here. And the challenges of new home affordability are becoming increasingly more difficult, which is driving more and more people to start looking at rentals. Population growth is something that has become very high in the last few years. And it's an interesting thought only in the sense that as it stands today, we already have a housing issue. We've got the least amount of housing per person in all of the G7 nations. We're only building about 180,000 homes a year, and we're bringing in 465,000 people. That's good for economic growth, but it makes it very tough on the real estate consumers. And it means that there's going to be less supply available. And think about it this way. If we've got a problem today, and we're only going to build 180,000 homes a year, and we're bringing in 500,000 people, you can almost bank on the fact that we're going to continue to make that problem even worse and make the real estate situation even harder to participate in. Here's just a look at some of the key cities around Ontario, because that's predominantly the market that we focus in. Look at those growth rates over the last 5 years. I mean, it's stunning to see the amount of people that are coming into this country over the last few years. Here's just a quick snapshot when I talk about that scarcity of land. What I really want you to look at is just kind of the green portion there. That's the protected green belt. That's something that we will not build upon. But if you look at the blue portion, that's sort of the urban settlement. I kind of joke with people, but I say we're kind of on an island, because if you look at the available space there, we're running out of room. And, we're not Dubai, so we're not going to start building onto the water. I don't think we're going to go that fancy anytime soon, but it really means we've got a limited amount of space. And as we continue to bring in more people, it is inevitably going to continue driving rents and cost of homes higher. This is what makes the investment thesis so interesting here. The difference is that, yes, you can go out and buy real estate on your own. But, I think I even saw some comments when I first joined in here that, having the down payment to go out and buy a rental on top of the fact that you may have had to buy a principal residence, finding 20 or 30% to put down on properties here in the GTA that are, $1 million, $800,000, you're talking about $160,000 to $200,000 minimum that you need to put down on these properties, let alone the fact that you need to have the income to suffice the financing options. And most of all, it's the time commitment. There's a real value to your time. And if you've got to deal with tenants, or in the middle of this presentation, you get a call because something at the rental has blown up, well, you got to deal with that. So when you look at actively managed investments, the benefit is really that there's just no effort on your part. Aside from the fact you might have to sign some paperwork and talk to an individual like myself to get started, that's really the extent of which you have to go. You don't have to worry about financing. And here's the kicker. You can actually use your registered funds. RSPs, TFSAs, locked-in retirement accounts, all of the above are available for our investments. So I want to give you a bit of an idea now that you kind of know who Equiton is, this alternative market that we're participating in. Let's have a look at some of the investment options that we have here. I'll move through it fairly quickly, but just remember that I'm just giving you the key details here. Anything you see here, you can definitely get access to later on by just reaching out to Andrea, and she'll be more than happy to set you up into contact with myself or send you one of the recordings if you want to review it on your own time. So if you take a look, we've got 3 different offerings. I would really put it into these 3 segments. The residential income fund, I kind of refer to as the apartment fund, 8 to 12%. People kind of go, well, why wouldn't I go for the 12 to 16 or the 20%? Think about it this way. The 8 to 12 is going to be your very consistent, tried and true, you know what to expect every single year, consistent performing investment. If you're someone that doesn't like a lot of risk and you just want to know what to expect every single year, the residential fund is the one that I would really tell you to focus on. If you're someone that has a little bit of a longer time frame, you're okay with a little bit more risk, and you want to diversify, that's where the income and development fund comes into play, because you get a consistent baseline of cash flow every year, but you have the opportunity for much higher returns over a 5 to 10 year period. And if you're someone who likes to participate in development opportunities from start to finish, we have multiple development offerings that we bring out throughout time, which I'll actually show you an example as we get to that portion. But let's have a look at our apartment fund. We call it the apartment fund because it's essentially all apartment buildings. The strategy here is pretty simple. The slide's got a bunch of information. Think about it this way. We're focusing on buying 3 different types of apartments. We buy value add apartments, so buildings that need a little bit of work, a little bit of capital expenditure. We also buy properties that are new builds because they're very efficient, low amount of capital goes into them. And we also buy some development projects for purpose-built rentals. So these are the 3 categories that are going all into this one fund. To give you some highlights, if this is a key point that you want to take away from the slide, I think this is a great piece of information. That targeted return is 8 to 12%. But again, the key, consistent. It pays a monthly cash flow, which, by the way, you can reinvest that or take it. It actually starts with a $10,000 minimum investment. So by the way, even if you didn't qualify for any of those eligible investor things I just shown you on the other slide, you can still invest up to a maximum of 10. So we wanted to make sure this investment was still available to you. And it is once again registered plan eligible. Sometimes people ask me, okay, 8 to 12%, got it, but where does that actually come from? This is how you get your returns. 6% of it is via a monthly distribution. So think about it, 6% for the whole year, but divided out over equal payments each month of the year. And that drip just means that you can automatically reinvest with a 2% bonus. And then you have capital appreciation of 2 to 6%. The one thing I say to people is that this is no different than you going and buying rental property. If you got a rental property, you get 3 things. You'd have your tenant who pays you monthly cash flow. Well, that's what we're doing because we just distribute the income from all of our tenants. And then you pay down the mortgage and you hope that the property value goes up over time. That's exactly what we do with capital appreciation. Here's a bunch of stats. Take from it what you will that you find most interesting, but just have a look at the top left box there. This fund, this investment was brought about 83 months ago. And in 83 months, we've never had a negative month of returns. 83 consecutive months of positive returns. And then if you jump all the way to the right side, yes, I just told you the target was 8 to 12%. 2022, extremely tough year for returns. We did a 14% net return to investors. That's exactly what investors saw in their account. And if you think about that, that's in one of the toughest years we've seen in 15 years. And it's all due to the fact that we have a very stable portfolio of apartments and rents have been on the rise. We've actually been outperforming our target due to the fact that this environment has been very beneficial for us. Here's a look at just what your $100,000 investment, if you had started 83 months ago, would have looked like today. Yes, it says 176,000, but there's a bigger takeaway here. Do you remember that stock market chart I showed you? Try to compare that to an investment like this and put the volatility side by side. Like, this is as smooth as you could get from a return over the last 7 years. And I'd argue you to find something else that would be this consistently performing without ever having a negative month. This is just to give you an idea of where the properties are located. We focus mainly in Ontario. Recently, we've just diversified into Alberta, but 95% of them are here locally. And in fact, I'm sure if I chatted with most of you and found out where you're from, I could probably find a property that's not too far off from you, which just helps to make it a little bit more real. You're not buying into one apartment building. You're not buying into one unit. You're buying into a massive $850 million apartment building portfolio. And that is where your return is being generated from. The only reason I put this slide in is to show you that these apartments we're buying are not the 50-story glass towers that you see downtown Toronto. More often than not, apartments in Ontario look like this. Very familiar buildings to most of us. And these are the assets that we're looking for. One thing I like to do is really show people that we're not a fund that just sits around and waits for the real estate market to appreciate. We find ways to create value. Take a look at this building, 125 Wellington Street in Hamilton, Ontario. The reason I highlight this property is because, as I noted, your return comes from capital appreciation as well as cash flow. So if we can increase the value of a property, that increases your investment. We bought this property in March of 2021 for $54 million. And actually, in fact, the entire penthouse suites were almost completely vacant because there was a leak in the roof and it was basically ruining most of the units on the top floor. But we bought the building, $54 million with one floor completely vacant. We spent about $5 million in repairs to the roof, as well as renovating some of the units. We were able to get them fully rented out once again. These are 2-story units, so they rented for a good price. And we had the building appraised in June of 2022 for $79 million. In a year and 3 months, we were able to generate an increase of about $25 million and an increase of 45% to the property. A lot of that had to do with the fact that over that period of time, rents continued to increase. So while we were spending money fixing the property, we were basically just seeing a higher rent when we were able to actually rent out these units. This is another quick example. Really just look at the top right there. That was the previous layout of this property we have in Mississauga. I'm sure many of you are close to or know of Mississauga. This is actually 65 and 75 Paisley Boulevard. Quickly, we found some vacant space. There were some lockers here. People in the building weren't using them. We thought, hey, why not just turn these into rentals and we can rent them out? Well, if you look at the cost there, it spent about $2.8 million to add these 9 suites in this vacant space, but the appraisal value increased by $5.3 million. So just by finding this vacant space and turning it into new rentals, we were able to create value. So we're not just sitting around and waiting. And that is why I say this apartment fund is for somebody that likes consistency, you want stable returns, and you're investing into a very stable portfolio. And we are going to go out and do most of the work for you. And we are going to be able to find ways to enhance the value of the portfolio by doing some value creation like these examples. Let's have a look at the second fund I mentioned, the Income and Development Fund. I won't spend as much time because the theory is similar. It's just a different asset class. Instead of focusing on apartment buildings, we wanted to go a little higher on the risk scale, but also a little higher on the return scale. So half the fund is focused on getting income via commercial properties as well as private lending. And then the other half of the fund is going to buy into development projects so that whenever these developments complete, you get a special payout. Here's the fund highlights. So again, 12 to 16% annual return. The big thing here, $5,000 minimum investment. Still registered plan eligible, and it also pays a monthly cash flow. If you want to have an idea, this fund's a little bit newer, started in August of 2019, and that investment would now be worth about $138,000 today. Here's how you receive your returns here. It has the same amount of cash flow. So it's still 6% a year divided out over each of the 12 months. The difference is you won't really see any of that consistent growth because we don't have apartments that are going up in value, let's say. So the only time you see a return higher than that is when there's a special distribution from one of the development projects that are actually in the fund. So that's why we say that you should have a longer time frame, upwards of 5 years, because you want to get multiple of these special distributions to get yourself within that 12 to 16% targeted return. And that's why I say it's not as consistent as the apartment fund. For example, the income is coming from those commercial properties and private lending, as I mentioned. And then those development projects are different one-off investments within the portfolio. This is again, just to show you the volatility, let's say, of this actual fund, because it's been very smooth and consistent, as was the apartment fund as well too. I really just put this in to give you an example of some of the properties we're buying in this portfolio. So instead of apartment buildings, we're looking at commercial properties. We're looking at industrial properties. This is an example of one that we bought in London, Ontario. So maybe there's someone here that's actually from London. You might know this property on Hyde Park. These are the assets we're buying into with really strong commercial tenants like banks, CIBC, and Wendy's food chains. I like to call them COVID proof, let's say. So these are the type of commercial assets you do want in your portfolio. And 2020 kind of proved that to us, what is the best category. And then lastly, we've got Sandstone's condo development. This project here is something where you can now participate in the development of a condo. I'm not talking about buying a pre-construction unit. I literally mean you get to participate in the purchase of the land, which is currently a retail plaza, and participate with us all the way along of rezoning, pre-construction sales, construction, and occupancy. And that's how our investors make money, is through the creation of new real estate assets. We're building a 12-story mid-rise condo out in the east end of Toronto, very close to the Bluffs. So for example, this is just to give you an idea. These are the key points with a fund like this. You're looking at a 5-year, 4-month, or 5.33-year time frame. The biggest thing here, this is completely locked in. So you really need to make sure that you're comfortable with the time frame, and you really don't need access to the funds. The big benefit is you get large payouts. So you're looking at a total return on investment of about 106% upon completion. If you do the math, that works out to about 20% a year. So very, very good returns. And the minimum here is $25,000. As noted, all of our investments, including this one, are able to be used within registered accounts like RSPs and TFSAs. This is the option if you really are looking to truly diversify within real estate and go for those longer term, higher returns. I put this one in just to kind of give you proximity of where this project is actually going. This is actually located at 2257 Kingston Road. And you can actually see that that orange plot right there is where we bought the commercial plaza that we're going to be rezoning and building on. And just to the left of it, you'll actually see there's already a condo there. I can get into this for quite some time, but that's a huge help because it set precedent in the area and made it much easier us to actually follow the projected timeline that you see on the left side there. If you have more questions, again, you're welcome to reach out after the presentation. To sum up, I really like to say to people that the benefit of private real estate investing, it really goes to the mantra of what this whole event is about tonight. Earn while you sleep. You don't need to do the legwork, and that's why we put ease there. You don't have to be the landlord. You don't have to deal with the properties. This is a great way for you to be able to take some of your funds and park them into real estate assets and diversify into different categories that you may not have had access to before. Development, institutional apartment buildings, commercial properties. It's diversity. You're getting access to a whole wide range of different assets. And at the end of the day, being able to use your registered accounts is such an advantage because you could have enough cash to go out and buy another property or go and do a rent or a flip. But if you've got those RSPs or those LIRAs that you really can't be using for real estate, here's your chance to get more participation in the space that I assume you already love. It provides income, and at the end of the day, this can be very tax efficient if you're using non-registered funds, and that'd be something I'd be happy to go into on a personal conversation if you want to find out. So one thing I would like to say to people is that, at the beginning I asked, are people truly diversified? I really like to say that I think not. I think most people probably aren't truly diversified. If you didn't know that you could get access to these private capital markets, that's a whole segment of the market that you're missing out on. Understanding that you can use your RSPs and TFSAs to get access is such a huge benefit. And now you know that you can start to diversify your portfolio into things that you may have thought were previously unobtainable. So that's where I really like to just kind of turn it around, give you the opportunity to ask me any Q&A that you may have. I know we're running into close to about 7:50, almost 7:55. So feel free to ask a couple questions here. And then if time gets cut off short, reach out to Andrea and she can tell you how to find out some more information about this. So if you want, I'm welcome to take a couple questions here. And Andrea, you can cut me off whenever you're good to go.
Sure. Yeah, I was just checking in the chat to see if we had any questions come up. You can always type your questions in the chat, or you can raise your hands, where we would love to answer a few, or as we said, you can absolutely book and find out more through speaking one-on-one with myself and or Austin.
Yeah, and
Any-
since I don't see any questions right now, sometimes it's good to kind of kickstart some of the things. I put this screen up because one of the first things I'll usually get again is, what was the minimums? Again, the minimum start at 5,000. And then the next question people will usually have is, well, what's the minimum amount of time frame I need to stay invested? If you look at the two options on the left side, the residential income fund and the income and development fund, the minimum time frame to stay invested is 3 years. After 3 years, you can do whatever you want. And actually, it's nice to know that if you had to redeem before the 3 years is over, you actually still could, just with an early redemption penalty. So we always say you should have a minimum 3-year time horizon in mind, but life can happen. And if life does happen and you need access to the funds, at least you could. So those are some of the biggest questions I usually get.
That's good. Yeah, I think that's important because you're right. Things can change before we realize it. And
Yeah.
we've
Well, it's
seen
like,
that.
sometimes we talk about people with the developments and, they're kind of on the fence about it. And I think, yeah, I could probably do 5 years. The moment I hear probably, I go, don't do that. Because you really need to be sure with development that that's something you're willing to commit the time to, versus these other two options are things that you can feel a little bit more comfortable with. Know you have a couple different options. And that's the reason why we have these various different real estate investments, is to give you the diversity to match what you're looking for.
Yes.
I see, Paula, you asked about, please provide more details regarding connecting this to RSPs and TFSAs. So for example, a lot of you probably have your RSPs and TFSAs with probably one of the top 5 banks in the place I came from. You can't buy these investments through your traditional financial institution just yet. So traditionally speaking, we use Olympia Trust, which is a third-party custodian, and we can help with opening an account there and transferring your funds to Olympia, and then you're able to make investments into this company. Chantal, I see you asked about using non-registered funds and what are the tax implications. Chantal, I think it's a really good question. There's going to be a little bit of a different tax implication on every one of these funds. So I definitely say reach out to Andrea and she could set something up with you and I where we can go into more detail. For simplicity, the development offering on the right, if you use non-registered funds, that's fully taxable when it pays out, versus something like the residential income fund is actually 100% tax deferred until you sell. So there's an extremely huge benefit of being able to defer the tax bill to a time that may be strategic for you. And here's the kicker: when you do sell, all of your profit is capital gains. So if you want to chat more about that, definitely reach out to Andrea and she can set you up.
Yes, and we do offer, like, our booking is a free session just to sort of get more insights from you, as to what you're looking for, so that we can provide you with some guidance. And then we do offer the introduction to Austin at Equiton, so that you can then find out more specifically what you have. And like Austin said, he would then help you through that process, with Olympia Trust helping to move, especially those registered funds. And I mean, registered funds comes in the form of the RRSPs and tax-free, but some of you have LIRAs or DPSPs. You have different things that you may have accumulated. And I often find that people don't even know that it's just sitting there, or they left a previous employer and it's still there and maybe nothing is happening with it. These are excellent sources of capital that you can use to put into these types of funds. But each of you have very different situations, tax implications and needs, and we can definitely address those with you one-on-one.
Yeah, and I think you've kind of hit it right there, Andrea, because I think the biggest part I like people to realize about having these conversations is that, this is more about education. I'm happy to chat with anyone who's curious about the space just a little bit more, ask the questions you might be curious about, educate a little bit more about the private markets, the investments themselves. And if this is something that ends up working for you, I will make the process as simple as possible. And, any individual who's worked with me has known that I'll try to make that simple. It's more important, though, that we focus the time on understanding what you're investing into and why it makes sense for you. And that's the biggest part of the learning here.
Okay, awesome. I think we're good. As we said, this will be available for you in a replay so that you'll have that to go back over and see if there's any of the slides that you maybe want to revisit, and then formulate what your next steps are as to reaching out to us so that we can help direct you and help guide you along your journey to find some passive, investments so that you can earn while you sleep, play, work. And that's what I love about passive investments. Okay, I'm going to see if I can just get my screen back up again, Gideon, just to, yep, I see it here, just to close out. I really, really appreciate, Austin, you taking the time to come and educate us and share with us and our passion. I know I can see that you're passionate, and then you come from a history of, real estate investors through your family as well, so that it was natural, your connection with Equiton and what they're doing there. And I think it's phenomenal what you've done, what the company has done in such a short space of time, that it's Canadian. I love it. But just to let you know, we're here for you, whether you're looking to just get more information, or you have some capital that you want to figure out how to and what to do with it. So please feel free to reach out to us. We have our website that you can go to and connect with us, our Facebook group, Instagram, we're on LinkedIn, YouTube, and we definitely have resources through our webinar jam that we can give to you to help educate you in different areas of real estate that are at no cost to you, depending on what you're looking for. Again, I think Gideon has shared in the chat the link to connect with me, and you can connect with us in these other ways. I saw some of you trying to get in today through our Instagram, and we're always looking to see if you're reaching out and needing information so that we can help you. Also, remember, save the date. September 30th is our tentative date that we want you to keep in mind for our live event of Earn While You Sleep, where you can get a chance to, talk to and meet and touch and see, people live and handle and learn, because we're not just talking about real estate investment trusts when we say Earn While You Sleep. As you can see from our presentation tonight, there's many ways that you can invest in real estate passively, not even owning the property yourself, and still getting great returns because you're sharing in the returns that those properties bring. Any last questions before we say good night?
And thank you again, Andrea, for letting me come in and chat today. I'm always happy to speak about real estate, and your events have been one of the most helpful in terms of getting in front of new people, and you do such a great job of introducing everyone to different caveats of real estate they may not have been familiar with. So thank you to you as well for putting on these events.
Yes, I appreciate that. And as I said, we do appreciate your time here, sharing your knowledge and your passion, because I think we felt that through the presentation. So thanks, everyone. I didn't see any further. Let's just see. I think maybe we were just saying good night, but let's see if there's anything else. Awesome. Thank you all for attending. Oh, someone did say, what do the monthly returns look like with a 5? Oh, okay, that definitely is a bit more of a specific question, because it depends on where that 5 is going. Typically, as Austin said, it's the more consistent, steady investment that you're putting it into, and we can look at what that would look like if you're choosing to receive the distributions or the allocations that would be paid out. We can speak to that personally. Okay. Feel free. Let's see. Austin, did you want to type in the chat your contact information?
Yeah, definitely. I will throw that in right now, and then anybody is welcome to reach out to me as well. Okay.
Yes.
I'll even put my cell number in there, so if you want to bug me during the Leafs game, you're more than welcome to.
Yes, Austin is really good at responding. I don't bug you too much, Austin, but I do.
No.
I love that you do take the time to respond and follow up when I have to, look into some of my own investments. So thank you.
Of course, I'm one of those people who always appreciate a timely response. So I mean, listen, if you're going to reach out, I'll take the time to get back to you. So most definitely.
Yes, thank you. And I think you'll all find that there, Austin's typed the information in the chat. He's definitely easily accessible and will happily help educate you or direct you as to what would work best for you. Thank you, everyone. Gideon.
Thanks so much, Andrea.
Yeah, thank you, Austin, and have a good night. I hope I do get to see you at our multifamily event. I'm
We'll
planning to
cross.
come. I'm planning to
Yeah.
come. It's just a couple of things in the way, but yes, looking forward to seeing you live soon.
Perfect. All right. You have a great rest of your evening. Thanks, everyone.
Thank you. Gideon, did you stop or are you?